Hi folks, welcome to another episode of Who Said What. I'm your host Krishna, and for those of you who are new here, let me quickly set up some context for what this show is about. See, the idea is that I'll pick the most interesting and juiciest comments from business leaders, fund managers, and the likes and contextualize things around them. Now, some of these names might not be familiar, but trust me, they're influential people and what they say matters a lot because of their experience and background. So, I'll make sure to bring a mix. Some names you'll know, some you'll discover, and hopefully it'll give you a wide and useful perspective. Now, for all the sources mentioned in this video, don't forget to check out our newsletter. The link is in the description. With that out of the way, let me get started. See, Ola's latest results had a line that changes the way you read everything that follows. The company said that the electric two-wheeler industry has been largely flat for the last 2 to 3 quarters and used that to explain why it hasn't been chasing volume. Instead, they said they have taken the opposite approach, focusing on cost discipline and margin improvement. Now, on paper, the margin story might look little strong. Ola reported a 30.7% gross margin and even added that this is much better than many internal combustion engine companies. But a margin number never speaks for itself standalone. You have to place it next to what the company is doing with the volumes, how is it revising expectations, and what competitors in the same market are experiencing. Because in the same quarter, Ola calls the industry flat, Ather describes its own performance as one of the strongest ever. They sold around 66,000 vehicles in the second quarter, a 67% jump on a year-on-year basis. October registrations were nearly 50% higher than last year. Ather said that they were stocked out in several markets. Now, nothing about this resembles a flat industry, and the divergence doesn't just stop at pure EVs. TVS said domestic ICE two-wheeler sales grew 21% for them against industry growth of 8%. Scooters are growing faster than the broader market. Bajaj said October was at an all-time high for its Pulsar portfolio and that exports have reached a new peak after months of volatility. Now both of these companies are pointing to momentum. If Ola is describing the market as flat, it is the only one seeing it that way. Now part of this answer sits in the details Ola didn't emphasize on. Now back in July, the company publicly guided for 3.25 to 3.75 lakh vehicles in FY26 anchored on the festive season and the rollout of its Gen 3 platform. But in the latest con call, that guidance quietly fell away. Instead, the company said it expects to deliver just 1 lakh units in the second half. Even if you add the first half, the full year number comes in far below the earlier target. Now, a reset of that scale doesn't appear out of nowhere. And there's a missing piece here that the company didn't highlight directly, but you can see it when you compare it with the competitor commentary. If Ather is growing at 40 to 60% in multiple markets and TVS and Bajaj are seeing multi-year highs across premium and scooter categories, then someone's share is shifting. The simplest reading is also the most likely one. Ola didn't just see a flat market, it saw its own share being chipped away by competitors who are growing into the space it once dominated. The industry flatness line hides that possibility but doesn't remove it. Meanwhile, something else happened around the same time. Bhavish Agarwal pledged an additional portion of his Ola Electric shares, raising from the pledged stake from 8.09% in June to 10.11% in September. Now, if you put all the 4 con calls side by side, the contrast is sharp. Ola is tightening, Ather is accelerating, TVS and Bajaj are enjoying a different cycle altogether. And somewhere between these stories is the real state of the two-wheeler market. Tata Steel released its second quarter results of the year and they were fabulous. Its profit after tax more than tripled compared to last year. Now, in the face of global headwinds, be it Chinese steel exports surging, US tariffs, or shrinking steel demand in Europe, the business has largely improved. We will be breaking down these results in our coverage of Indian steel results soon on the Daily Brief. But in this episode, we'll be covering an interesting quote and a trend that we spotted in the con call. See, Tata Steel is working with the Netherlands government to decarbonize the steel plants they own in the country.
As Naren mentioned, we have recently signed the non-binding joint letter of intent with the Government of Netherlands and the province of North Holland concerning Tata Steel Netherlands' decarbonization journey. This joint letter of intent is an expression of mutual intent to explore a framework of transitioning to low CO2 production. I want to emphasize that this project will be designed and phased in a manner that is financially prudent Both the government and the Tata Steel has conditions to fulfill, and we are working on each of them. There is no material spend in the immediate period, and we will talk more in details on the project cost, the financing structure, and the project phasing closer to the binding agreement next year. We are also looking at prioritization, optimization, and sequencing on the capex, such that it is affordable for all stakeholders.
Now, if you have read our daily brief piece on Jindal potentially buying ThyssenKrupp, one of Europe's largest steel players, you might remember a similar thing playing out. A huge consideration in the deal is whether Jindal will decarbonize their biggest plant. Now, why is that? Well, Europe had a policy called Carbon Border Adjustment Mechanism, or CBAM, which aims to reduce emissions significantly. CBAM effectively adds a tax on carbon-heavy goods imported into the EU. It just so happens that making steel carbonless is really hard. It requires burning a lot of coal which is made from coal and therefore will release plenty of emissions. The alternative is using a clean fuel such as hydrogen. But generating hydrogen uses a lot of electricity and potentially makes the cost of steel around 50% higher, which makes the nature of Tata Steel's quote interesting. They say they have signed a letter of intent with the government of Netherlands, and earlier they also indicated their confidence that they'll do it on time. But in practice though, Tata Steel hasn't really taken the full plunge. For one, the letter of intent is non-binding. And so far there is no sign of financial commitment made. Talks between both the parties have been going on for at least a year, if not more. And that's not to say they won't do it. In fact, they don't really have much of a choice. At over 15,700 crores of revenue this quarter, the Netherlands makes up over 20% of Tata Steel's business. And it doesn't seem like a necessary precondition for doing business in Europe profitably. But across Europe, steel decarbonization projects have turned out to be really hard to execute, with multiple announcements of postponements and cancellations made this year. For instance, German steel producer postponed its next phase of its greening project by 3 years. Even ArcelorMittal postponed greening 2 of its plant in Germany despite receiving state aid over $1 billion. In fact, earlier this year, even ThyssenKrupp postponed a tender for green hydrogen because the fuel was too costly. It also doesn't help that it's hard to make money in Europe anyway. Demand has been flat there over years. It has been a devastatingly difficult market to crack for Indian steelmakers as they have faced multiple high-profile failures. While on paper, the optimism for European steel going green seems high, reading between the lines tempers those expectations. That's it for this episode. See you in the next one. Now I'll be breaking down these results in our coverage of the Indians. Now we'll obviously break this down.
2 hours later.
Now we'll obviously break down these results in our coverage of the Indian. Now we'll obviously break these results. Now we'll obviously break this.
One debt to society later.
Now we'll obviously break down. Now we will.
One pair of pants later.
Now we will be breaking down these results. We will be breaking down these.